What a week we've had.
What a year.
What a year, even. Just how do you stay invested in this market now?
Yeah, we continue to stay invested, but we turn to a more selective and more prudent and balanced investment strategy because we keep a neutral stand on building exposure to risky assets, but we very much focus on stagflation hedging strategy because now we have the inflation shock from both the US and Europe, and we expect central bank will turn more aggressive. So we expect inflation to go up further in the third quarter.
So risk assets on one side, how do you offset it with the stagflation scenario? Because commodities doesn't seem like that's the traditional hedge for inflation now.
Currently, we are overweight on commodity-linked asset class. So we overweight energy and material stock. We still believe financial stock will provide some hedge to interest rate hike risk, and we have an overweight allocation to hedge fund, particularly focusing on multi-strategy and macro hedge fund. And we think commodity-linked currency will likely do better in the second half of the year because I think the market have now priced in significant central bank policy rate hike. Currently, we expect another 75 bip Fed rate hike in July, followed by 2 more 50 bip rate hike. And then we expect policy rate in the US will go up to 3.625% before we may see a pause in policy tightening in the first quarter of next year. As we expect growth, we'll see more substantial slowdown in the next 6 months in the US.
Well, what happens, I mean, interest rates going up, a lot of companies, a lot of corporates are really levered up. This would, of course, expose that. Now, so what kind of companies are looking for good credit quality, I'm assuming? Probably a dividend play as well. And on top of that, arguably, of course, good valuation as well and free cash flow. So, I mean, these are the companies that would perhaps withstand what's happening.
Our portfolio strategy very much focused on quality, income, and diversification. And now we are facing significant disruption in the global economy. So we position in quality company which have the ability to adapt to the disruptive change. Those are companies with have strong balance sheets, with resilient cash flow, and strong.
The trouble is everybody else wants to go there as well. That's the thing.
Not all companies can fulfill this requirement. So I think for this strong and quality company with powerful adaptability to this macro challenge would actually outperform the market and also grow stronger in a tough macro environment.
So the second half, are you still thinking it's going to be much of the same? Or should I expect in terms of the macro picture, is inflation going to start to moderate later on this year? Or do you have to wait for 2023 for that story to play out?
Okay, we position for a volatile third quarter because headline inflation in the developed economy, particularly in the US and the Eurozone, will continue to shoot up. So this will bring volatility to the equity market. But in the bond market, we think bond yields have largely reflect the Fed policy tightening pace and the front loading of Fed rate hike have already pushed up bond yield to an attractive level. So we actually see value in the short to medium duration in terms of the yield curve. And we think investment grade bonds in the 3 to 5 years duration segment actually look quite attractive.
How does the dollar essentially play into all this? And where do you think the dollar goes next? That's going to be key, isn't it?
Yeah, I think after the sharp appreciation of the dollar, many investors would doubt whether the dollar strength can hold in the second half of the year. But when we look at the central bank policy tightening trajectory, the Fed is expected to lead in this round of policy tightening. So the ECB, the Bank of England, they will continue to lag behind the Fed in terms of the pace of rate hike. So we still position for a strong US dollar. And as you can see from Asian central bank actions, I think central banks outside the US continue to remain quite cautious about the impact of policy tightening on growth outlook, particularly
in Asia. You still like Hong Kong and ASEAN, though, equity markets.
Yeah,
why?
Also Australia.
Why?
and Japan.
Yeah.
I think the priority of Asian central banks still very much on growth, stabilization. So I think
They won't follow the Fed,
Yeah,
you
they would rather stay on the prudent stand in order to defend the growth outlook.